Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on lesson 8.5 of Unit 8, Price Action Trading. In this lesson, we're going to cover trend lines, uptrends, downtrends, and various chart patterns. By the end of this video, you will understand how to identify and use these patterns to improve your trading decisions. Let's get into it. A trend line is a diagonal line drawn along swing highs or swing lows. In an uptrend, we connect the swing lows to create a line that shows the overall direction of the price. Think of it like a roadmap, helping us navigate the market's movement. We'll use this line to identify potential areas of support and resistance. An uptrend is a series of higher highs and higher lows. This means that each new high is higher than the previous one, and each new low is higher than the previous one. It's like a staircase, where each step is higher than the last. We can draw a trend line connecting the lows to help us visualize the uptrend. A downtrend is a series of lower highs and lower lows. This means that each new high is lower than the previous one, and each new low is lower than the previous one. It's like a staircase, where each step is lower than the last. We could draw a trend line connecting the highs to help us visualize the downtrend. A head and shoulders pattern is a bearish reversal pattern. It consists of a left shoulder, a higher head, and a right shoulder. The neckline is drawn by connecting the lows of the two shoulders. If the price breaks below the neckline, it's a confirmation of the reversal. An inverse head and shoulders pattern is a bullish reversal pattern. It's the upside-down version of the head and shoulders pattern. If the price breaks above the neckline, it's a confirmation of the reversal. A double top pattern is a bearish pattern. It occurs when the price hits the same resistance level twice and fails to break above it. If the price breaks below the confirmation line, it's a signal to enter a short position. A double bottom pattern is a bullish pattern. It occurs when the price hits the same support level twice and bounces back up. If the price breaks above the confirmation line, it's a signal to enter a long position. An ascending triangle pattern is a bullish continuation pattern. It occurs when the price makes higher lows and meets a flat top resistance. If the price breaks above the resistance, it's a signal to enter a long position. A descending triangle pattern is a bearish continuation pattern. It occurs when the price makes lower highs and meets a flat bottom support. If the price breaks below the support, it's a signal to enter a short position. A bull flag pattern is a bullish pattern. It occurs when there's a sharp move up, followed by a tight consolidation. If the price breaks above the resistance, it's a signal to enter a long position. A bear flag pattern is a bearish pattern. It occurs when there's a sharp move down, followed by a tight consolidation. If the price breaks below the support, it's a signal to enter a short position. The key rule to remember is to wait for the pattern to be confirmed by a breakout before entering a trade. This means that we need to see the price break above or below the resistance or support level before entering a position. That is everything for Lesson 8.5, Trend Lines and Chart Patterns. If this helped you, smash that like button and subscribe to Tick to Loot so you never miss a lesson. Drop a comment below. What was the most useful thing you learned today? See you in the next lesson, looters. Keep turning those ticks into treasure.